Hello. Well, it's only 5 p.m. on a Monday afternoon in Australia, so Europe and the US, Europe's just waking up, and the US is yet to arise, and it already feels like a long week. I guess because there's a lot going on. Um, you know, that economic data in the US on Friday, where producer prices were up 0.3%. That's not so bad. It's kind of a normal number, really, nothing to get scared about, even if it is greater than what people wanted. But the core was up 0.5%. That was a bit of a worry. And we're also seeing a lot of weakness, as you know, recently. US retail sales down sharply. Industrial production has been a non-event for several months now. And I won't go on about that because I've said it a few times, but there's a lot of weakness in the US economy that people really aren't paying enough attention to. I've said since the start of the year there was a chance this year that the Fed won't cut interest rates at all, and the rekindling of inflation is happening just as US economic data is beginning to soften again. So there will be calls and cries for the Fed to cut rates, but they've said time and time again, over the last couple of years, that they see inflation as enemy number one. I mean, their big mistake is they think they can control US inflation when it's often driven by global pandemic or geopolitical tensions in terms of energy prices. So I just see all of that Federal Reserve approach to monetary policy as being highly outdated and in fact damaging to the US economic outlook. So we're not going to get an easy reprieve, if you like, for the US economy from the Fed, and it is softening. I mean, apart from AI and some narrow tech stocks, US stocks aren't making record highs. Most of the majority of US stocks are actually down 10 to 15% from the highs of a couple of years ago. So just be a little bit wary that the US equity scene is getting more and more fractured. That doesn't mean you can't make money being long, but it is getting more and more fractured, and that the Fed may not be cutting interest rates till next year, although probably fourth quarter is a possibility if, and this isn't a political viewpoint or desire, it's just calling it as it is. Middle of last year, I forecast Trump will win the next presidential election. Doesn't mean he'll be the next US president. Kamala Harris could be the next US president at any moment, and that would be a reason to sell equities. But in terms of the next presidential election, Trump is very likely to win, and that could see some kind of peace talks develop regarding Ukraine, and it could see energy prices begin to soften. Also, as we have so many economies going to recession at the moment, the UK is in recession, Japan's in recession. I like how the bulls call them technical recessions. That's a new term that only developed itself in recent years as the bullish spin doctors of Wall Street pull out all stops. No, it's not a recession, it's only a technical recession. No, it's a recession in the UK and Japan at the moment. And also, I think it's a recession in Germany. They've had 3 quarters of flat or negative growth. And the idea that, no, Germany's not having a recession because it's had 2 quarters of 0.0% growth, that's just absurd. Obviously, it's an economy in trouble and languishing. Canada just had a bit of a crash quarter in its GDP. If you add the last 2 GDP quarters together, Canada's been flat for the last 2 quarters, though that first one of those was a reasonable number. And I think everyone in Australia except the Reserve Bank knows that Australia is sliding towards recession. I mean, whenever you look at the Reserve Bank, there's 2 things you have to ask. What should they do and what will they do? Because usually they're entirely different answers. I noticed that one of the major Australian banks today came out and said they're going to cut rates 6 times. And then they said, but only by 0.75%. So it's a lot of small cuts. Very odd forecast from CBA, and giving the RBA far too much credit that the RBA could be smart enough to figure that out. Particularly as oil prices are firm, and higher oil prices are one of my favorite trades at the moment, and have been, as you know, for some time. Towards Trump becoming president, though, I might back off from that trade, but for the moment I'm still very bullish oil, and that's going to keep global inflation warm, if not hot, which when you have central banks that still operate from 1960s textbooks and this absurd idea that they somehow control inflation. I mean, it's completely beyond their domain of influence, and yet they think it's all them. when it's just other cycles that are happening that push inflation up or down, and it's not the central banks controlling it, but because they think they do control it, they're probably going to keep interest rates too high for too long. Remember, when we're at near zero historic low rates in both the Fed and Australia, I said the central banks are going to make, the Fed and the RBA are going to make two big blunders, and I said this in the middle of COVID. They're going to keep rates too low for too long, and then they're going to have to chase inflation after the fact, and they'll go over hike, right, and overdo it to the upside. And that's exactly what's happened. And again, now they're going to be slow to realize their error, and they're going to be confused because their 1960s textbooks models don't work. I mean, basically, there's no one at these organizations with any real imagination, because anyone who displayed imagination was removed from the organizations, because they're only interested in backward-looking data where they can justify anything they're saying because they're only talking about the past. All right, I hope that helps in some way. I'm cautious on equities. I'm confused about the US dollar, and I'm bullish oil and a little bit bullish gold. And Disney, I think, if Disney makes a new high now, Disney could be an surprise outperformer going forward. All right, have a great day. Thanks.